BlackRock has been quietly preparing to capture your savings, and now their technical solution has arrived. CEO Larry Fink recently confirmed that the world's largest asset manager is developing its own proprietary system to tokenize assets. But instead of using public blockchains, BlackRock is building something far more centralized and scary. And that's why today we're uncovering the real $68 trillion reason behind BlackRock's tokenization push, how they plan to use crypto for control, and what it all means for the markets. My name's Nick, and you're watching The Coin Bureau. First up, I'm not a financial advisor, and nothing in this video should be considered financial advice. It's purely educational content intended to inform you about BlackRock. And if that sounds good to you, well, make sure to smash that like button and let's get into it. Now, as revealed in the summer of 2025, BlackRock CEO Larry Fink has been rolling out what he calls the, quote, second draft of globalization. In simple terms, it's a plan to mobilize global savings and redirect them into one of the largest investment programs in history, a $68 trillion infrastructure push. According to BlackRock, that's the amount needed over the coming decades to rebuild the world's infrastructure and fund the United Nations Sustainable Development Goals, or SDGs. The problem, of course, is that governments and corporations don't have anywhere near the amount of capital needed for that. So, where will all that money come from? Well, from us. BlackRock's strategy, which we've already seen take shape in the EU's proposed Savings and Investment Union, is to funnel citizens' savings into these projects, often through automatic enrollment in pension funds. These pension funds, naturally, are managed by asset managers like BlackRock, and the result is that ordinary people end up financing massive ideological projects they neither chose nor control. And the size of this prize is enormous. BlackRock's target is the trillions of dollars sitting idly in low-yield savings and money market accounts. In the United States alone, that's more than $25 trillion, worth another $13 trillion across the European Union. Together, that's roughly $40 trillion in potential fuel for what could become BlackRock's global investment engine. But there's a major problem. Liquidity. Most of the assets BlackRock wants to fund, bridges, power grids, data centers, ports, and even private equity, are deeply illiquid. They tie up capital for decades. Larry Fink has even admitted that adding private market products to retirement portfolios introduces, quote, instruments that have less liquidity. And that's a serious issue. To funnel our savings into these projects, BlackRock must satisfy strict fiduciary standards. Simply put, they have to justify every single investment and, crucially, ensure investors can access liquidity when needed. But nobody today wants to lock up their savings for 30 years, especially not in something as illiquid as a bridge or a data center. The money sits where it does precisely because people need access to it. And this is the $68 trillion problem BlackRock has to solve, a challenge that may reveal their true motivation for tokenization. To overcome it, they need a system that makes illiquid, long-term investments behave like liquid assets. And that's where tokenization comes in. By putting a bridge, a data center, or a portfolio of private equity on a blockchain, BlackRock can fractionalize these assets into thousands of tiny tradable tokens. Suddenly, a locked-up infrastructure investment becomes a liquid, programmable instrument. For BlackRock, this isn't a technological experiment, it's a necessity. Tokenization is the key that unlocks trillions in pension capital, and perhaps the only way their global investment strategy can truly work. But liquidity alone isn't enough. BlackRock must also make those assets compliant and controllable, because when you're dealing with trillions, oversight becomes everything. And this is where BlackRock's proprietary platform comes in, and where the Aladdin system takes center stage. Earlier this year, BlackRock acquired Preqin, the world's largest private market data company, with the aim of integrating it into their flagship risk management platform, Aladdin, and their private markets platform, eFront. Together, these systems create the analytical backbone BlackRock needs to justify every investment to regulators and fiduciaries. Think of tokenization as the liquid layer, and Aladdin as the compliance paper trail that makes it all possible. And this data dominance also gives BlackRock an edge in the enormous money market fund industry, a $7 trillion sector that JP Morgan has recently called, quote, a significant leap for finance. So, as yield-bearing stablecoins put pressure on traditional funds, tokenized versions of these assets have become essential for TradFi's survival. And that's why BlackRock has joined the private permissioned blockchain initiative led by Goldman Sachs and BNY Mellon. This network allows tokenized money market funds to operate under full compliance while keeping everything on highly controlled rails. In other words, it's about securing a position at the heart of the financial system's plumbing. But that raises an important question. Why doesn't BlackRock just use a public blockchain like Ethereum? Well, the answer is one word: control. Sure, BlackRock can influence public chains through its spot Ethereum ETFs. It can run validators, and thanks to its close relationship with Circle, it indirectly controls a significant share of on-chain liquidity via USDC. But there's one thing even BlackRock can't fully control: the social layer. Institutions are hyper-aware that the Ethereum Foundation and its core developers ultimately hold the final say in governance decisions. And given the perceptions of foreign influence, no trillion-dollar firm is going to park politically charged, regulatory-sensitive assets on a network it doesn't control. And if you'd like a deeper dive into that, by the way, we've actually covered it in a separate video, which you can watch right over here. So, as a solution, BlackRock has adopted a dual-track strategy. On the one hand, by joining the Goldman BNY network, it's building its own proprietary rails to tokenize money market funds and other assets. On the other hand, it's working to reshape regulation in its favor. Back in January 2025, Larry Fink publicly urged the SEC to, quote, rapidly approve the tokenization of bonds and stocks. And that's because tokenization doesn't just make assets efficient, it also solves one of corporate America's biggest headaches: proxy voting warfare. With tokenized shares, ownership is instant and transparent. Every holder of record can be notified automatically, which slashes administrative chaos and, of course, legal costs. And this ensures they're positioned to lead the future of reserve management once tokenized finance becomes the norm. And while BlackRock builds its own dystopian version of the future, if you're looking for non-dystopian real-world assets, make sure to check out the Coin Bureau Deals page. Over here, you'll find exclusive sign-up bonuses of up to $100,000, plus trading fee discounts of up to 50%, and cashbacks on deposits of 75% on some of the best crypto exchanges around. Just hit the link in the description or scan this QR code on your screen. Once you're on the deals page, check out all of our partner offers and click Sign Up Now to claim your deal. Now, these deals won't be around forever, so be sure to take advantage of them ASAP using the link down below or the QR code. Back to the video. Now, BlackRock can't fully benefit from tokenization if those assets remain locked inside private silos. It also needs something only crypto can offer: 24/7 global liquidity. So the question becomes, how do you combine institutional control with the open composability of DeFi? Well, the answer lies in BlackRock's existing products, specifically its tokenized money market fund, BUIDL, and its DeFi counterpart, SBUIDL. BUIDL, which now holds over $2 billion in tokenized US treasuries, already runs on public blockchains like Ethereum. It's BlackRock's proof of concept that traditional assets can become instantly tradable and globally accessible. But the real breakthrough came in May 2025, when BlackRock and their partner, Securitize, launched SBUIDL and introduced what's now known as the S-token framework. Before SBUIDL, most tokenized assets existed purely as static representations on-chain, which means they could be viewed but not used in DeFi. SBUIDL changed all of that. It's an ERC20 token that brings US treasuries directly into protocols like Euler, where they can be used as collateral for lending and borrowing. In essence, it's turned a static treasury into a programmable, composable money Lego. But the real purpose of the S-token framework isn't utility. It's control by code. The S-token acts as a programmable wrapper that enforces transfer limits, ownership rights, and jurisdictional compliance directly within the contract itself. In plain English, this gives BlackRock KYC-compliant DeFi. Users can interact with public blockchains, but if they step outside of the rules, the code simply switches them off. And this is what makes BlackRock's approach a hybrid model. They're building a private permissioned technology for their own systems while leveraging public infrastructure like Ethereum for liquidity and composability. That design became even clearer in September when Securitize rolled out an off-ramp for instant 24/7 swaps between BUIDL shares and Ripple USD. In short, BlackRock is turning open DeFi into a tightly controlled bridge between TradFi and crypto, a regulated programmable utility layer for its own capital flows, making permissionless systems play by permissioned rules. So let's actually take a step back, because the idea of putting every asset on one ledger, each tagged with its own unique ID, isn't new, and it isn't isolated. It fits perfectly with what's already been developed by the Bank for International Settlements, or BIS, which is the so-called Bank for Central Banks. The BIS has spent years developing private permissioned blockchain designed to literally encode policy and regulatory rules into the code itself. The goal is the ultimate convergence, a system where central bank digital currencies, or CBDCs, become the primary medium of exchange, and every asset is tracked, verified, and programmable. Even Citibank described this fully tokenized framework as the, quote, end state of the financial system. But tokenization isn't just a way to make assets liquid, it's the mechanism being used to fund a much larger ideological agenda, the UN's Sustainable Development Goals, or SDGs. BlackRock's $68 trillion infrastructure drive is designed to meet those goals, and at the core of that system lies the digital ID. Under SDG 16, every country must roll out digital identification by 2030. In BlackRock's tokenized future, your house, your investments, even your ID are tied to a built-in crypto wallet, all stored on the same centralized ledger. And this is how the idea of own nothing and be happy could become reality, because ownership itself turns digital and therefore programmable. So if someone steps outside of accepted norms or defies a government mandate, access could, in theory, be switched off. It's sold as convenience, but in practice, it's compliance by design, a world where freedom depends on whether your wallet still works. And to make sure people accept it, the elites are playing both sides because they know the public are sick of establishment politics. We've seen it before, sudden U-turns on ESG and libertarian-leaning figures like Javier Milei being embraced by World Economic Forum insiders despite their rhetoric. Which brings us to the most important question of all. What does all of this mean for the markets and for you? Well, despite some of the dystopian undertones, there are positives to consider. BlackRock's entry into crypto represents a major wave of legitimacy and capital for the entire industry. Their strategy effectively pushes trillions of compliant dollars onto blockchain rails, creating one of the biggest opportunities in modern finance. Case in point, the tokenization market is projected to surpass $10 trillion by the end of the decade. And institutional adoption isn't just coming, it's already here. BlackRock's IBIT Bitcoin ETF has become its most profitable fund, crossing $100 billion in assets under management. That success proves one thing. TradFi money isn't testing crypto anymore, it's monetizing it. As a result, institutional involvement is translating directly into real market demand, especially for the cryptos tied to BlackRock's ecosystem, from Bitcoin to Ethereum. Products like the BUIDL fund, which relies on Ethereum for utility, only reinforce that trend. So if you're trying to anticipate where the money flows next, keep your eyes on established chains like Ethereum, Solana, and Avalanche, which currently offer the only 24/7 liquidity infrastructure for products like BUIDL. Then keep an eye on purpose-built chains such as Ondo, which are designed for institutional-grade compliance and tokenization from the ground up. But naturally, there's another side to the story. While BlackRock clearly values the technology that underpins crypto, it doesn't share the decentralized ethos that created it. Once their proprietary infrastructure is fully operational, their private rails could siphon institutional volume away from public blockchains, weakening their network effects and revenues. And even if their tokens move across public chains, ultimate control would still rest within their own system, the opposite of decentralization. So what can you do if you don't want to become just another tokenized data point on BlackRock's ledger? Well, first, question the narrative. Be wary of believing that BlackRock or its allies stand for decentralization. Their closest aligned assets, especially some stablecoins, are the ones most likely to be weaponized for control. BlackRock and other big asset managers didn't embrace crypto out of goodwill. They did it because they realized that if they didn't, the technology would eventually threaten their monopoly on power. Second, own what can't easily be tracked, and that means holding physical assets such as gold and building communities that value independence over convenience. The strongest defense against digital control is a network of people who think differently. And finally, support permissionless crypto. At its core, this technology was built for freedom, the ability to use your assets whenever you choose without anyone's approval. The projects that will matter most are those that preserve privacy, self-custody, and genuine decentralization, not the ones slowly being co-opted by traditional finance. Because while the launch of crypto ETFs has supercharged interest in crypto, it's also blurred the lines between adoption and assimilation. And if we're not careful, the very tools built to set us free could become the ones that lock us in. So, let's just hope enough people realize that before it's too late. This is Nick signing off. Thank you guys very much for watching, and I'll see you again soon.
Hey folks, before you go, I have a special announcement to make. If you enjoy the macro-focused content that we post here on Coin Bureau, then good news, you can now watch it on its own dedicated channel, Coin Bureau Finance. So, from now on, we'll be posting our non-crypto content on this new channel that's focused on all aspects of modern finance and investing, while keeping this channel dedicated entirely to crypto. And you can learn more about Coin Bureau Finance in this video here, and you can subscribe to the channel down here. Thanks in advance for your support.